Welcome you. Today we're diving deep into something pretty important, the U.S. economy, and specifically our trade balance.
Yeah, it's a topic that keeps coming up.
Exactly. And what's really caught our eye is this, well, surprising solution that Warren Buffett proposed years ago.
Yes, the import certificates idea.
That's the one. We looked at an interesting article you shared from Neep Sung Thirang that connects these long-running concerns with Buffett's, well, let's call it unconventional thinking.
It really does tie it together well.
So our mission here is to unpack that idea. Why did Buffett suggest it way back then? And importantly, how relevant is it today, given where the U.S. trade deficit stands?
Well, it's fascinating because Buffett wasn't just commenting recently. He'd been ringing the alarm bells about the U.S. trade deficit for decades.
Decades, really?
Oh, yeah, that 2003 Fortune article the source mentions. That was a key piece where he really laid out his thinking in detail.
Okay, maybe let's just quickly recap the basics. A trade deficit, that's just importing more than you export, right?
Fundamentally, yes. Goods and services coming in outweighing what's going out.
And while that might sound okay initially, getting more stuff, Buffett saw a real danger down the road.
He did. He warned that consistently doing this, buying more than we sell, means we're essentially trading away pieces of America. Ownership of U.S. assets slowly shifts overseas.
Right, and he had that analogy, didn't he? Thriftville and Squanderville?
Exactly. That analogy really hits home. You've got Thriftville working hard, saving, exporting.
Okay.
And they end up holding all the IOUs from Squanderville, who's just consuming way more than it produces, living large. But eventually, Squanderville racks up so much debt that it becomes, and this was Buffett's term, potentially an economic slave.
An economic slave, that's strong language.
It is. It means working harder and harder just to pay the interest and dividends owed to Thriftville. Plus, there's the risk. Thriftville just loses faith that Squanderville can never really pay it back.
And Buffett's fear was clearly that the U.S. was becoming Squanderville.
That was the core of his concern back then. And he wasn't just talking hypothetically. He warned about, a serious economic consequences.
Like what specifically?
Like foreign entities gaining real financial power over U.S. assets. Think land, companies, bonds, and potentially a weakening of the dollar itself. It was a pretty grim picture.
It really sounds like it. And the numbers back then in 2003?
Yeah, the article reminds us the deficit was already over 4% of GDP, which is significant.
Okay.
And maybe more importantly, the rest of the world held, on net, $2.5 trillion more in U.S. assets than Americans held in foreign assets.
$2.5 trillion. Wow. Where was all that money parked?
According to the source, it was a mix. A lot in U.S. government debt, private bonds, but also stocks, real estate, actual physical and financial claims on the U.S. And Buffett also flagged another related issue, the flow of money. Investment income, dividends, interest payments was starting to flow out of the U.S. more than it flowed in.
Ah, so we went from earning net income from the world to paying net income out.
Precisely. He called it entering a state of negative compounding interest. Not a good place to be.
Okay, so that's the view from over 2 decades ago. Fast forward to today. Has the picture changed much?
Well, the recent data drawing from the U.S. Bureau of Economic Analysis, like the article mentions, shows the trade deficit in 2024 was around 3.1% of GDP.
So a bit lower than that 2003 peak, but still definitely there. The imbalance persists.
It does. But the really dramatic change is in that net international investment position.
Right, you mentioned that earlier. What's the number now?
Get ready for this. By the end of 2024, the U.S. net negative position was $26.2 trillion.
Wait, say that again.
$26.2 trillion. That's how much more foreigners own in U.S. assets compared to what Americans own abroad.
That is almost unbelievable. Compared to the $2.5 trillion back in 2003?
Exactly. It's ballooned massively. That kind of figure, it raises real questions about potential foreign leverage or influence down the line.
Yeah.
The deep entanglement.
Absolutely staggering. Okay, so Buffett saw this trend developing, this potential vulnerability, and he proposed a solution. The shocking one, as Nip Sunkatran calls it, import certificates, ICs.
Yeah, it was definitely outside the box. The article rightly calls it a kind of tariff by another name, but the mechanism is quite different.
How would it have worked exactly?
Okay, so imagine a U.S. company exports, say, $1 million worth of goods. Under Buffett's plan, they'd get their $1 million plus $1 million worth of these import certificates.
Okay, so exporters get these ICs. What then?
Then Any company wanting to import goods into the U.S. would need to buy those ICs from the exporters.
Ah, I see. So if you wanted to import $500,000 of electronics, you'd first have to go out and buy $500,000 worth of ICs on the open market from an exporter.
Precisely. It creates a direct market link between exporting and importing.
And the intended effect is pretty clear.
Yeah, twofold. First, it makes exporting more attractive, right? You get your sales revenue plus the cash from selling the ICs.
Sure, an extra incentive.
And second, it naturally limits imports to the level of exports, because the total value of imports can't exceed the total value of ICs generated by exports.
Okay, that makes sense. Now, the source draws a line from this idea to the tariffs President Trump later put in place. How close is that comparison?
Well, the goal is similar, reduce the trade deficit, but the how is different. Tariffs are a direct tax on imports.
Right.
Buffett's ICs use a market mechanism. They make importing dependent on the available supply of certificates generated by exporting. It's less of a direct punishment on imports.
And Buffett's thinking, as the article notes, was to try and avoid the usual problems with tariffs.
Exactly. Things like hitting specific industries unfairly, causing big geopolitical fights, sparking retaliatory tariffs, trade wars. His idea was meant to nudge the market towards balance automatically without governments picking winners or losers or directly antagonizing trade partners.
More of a self-regulating system.
Sort of, yeah. Which makes it interesting, as the article points out, that when Trump did impose tariffs, investors generally reacted negatively, even though the underlying aim had some overlap with what Buffett, a respected investor, had proposed years earlier.
That is interesting. Maybe it was the specific implementation, the uncertainty, the confrontational style versus Buffett's market idea.
Could be all of those things. The context matters hugely in international trade.
Definitely. Now, despite laying out these pretty serious concerns about deficits, Buffett himself has always been famously optimistic about the U.S. economy long-term, hasn't he?
Oh, absolutely. Consistently bullish on America. The article mentions his 2016 shareholder letter.
What did he say there?
He basically said, American business and consequently a large array of stocks is virtually certain to be worth far more in the years ahead. Pretty unambiguous.
That's quite a statement of faith. And he's putting his money where his mouth is, quite literally, right? With his will.
Yeah, that's a powerful point the source brings up. His instructions are for 90% of his wife's inheritance, after he passes, to go into a simple, low-cost S&P 500 index fund.
Basically betting on the broad success of American business continuing for the long haul.
It absolutely underscores his fundamental belief in the system's resilience and potential for growth, even while acknowledging these big structural challenges, like the trade balance.
Okay, so let's try and tie this all together. Buffett saw the risks of these ongoing trade deficits very early on, back in the early 2000s.
Right, and he proposed this really creative, market-based fix the import certificates.
A way to encourage balance, sharing some goals with later tariffs, but using a very different, maybe less confrontational mechanism.
Definitely different mechanism. And yet, despite those persistent concerns and that truly massive shift in the net international investment position, that $26 trillion figure.
Yeah, that number sticks with you.
Despite all that, Buffett's long-term faith in the U.S. economy itself remains incredibly strong.
So maybe here's something for you, the listener, to chew on. Given how much the global financial world and the U.S. trade situation have changed since Buffett first floated his IC idea, what are the potential long-term consequences of owing the rest of the world a net $26 trillion?
That's the big question. And are market-based ideas like import certificates still relevant or even feasible in today's hyper-connected global economy? It really makes you think about that delicate balance between trade, national debt, and ultimately economic sovereignty.